All right, good morning, everyone. I think we're about to begin our presentation today. Thank you all for coming. And I guess, Aaron, if you want to start us off. I'm Nick.
I'm Aaron, and today we're going to be presenting stock buybacks in science-based industries, value creation or value destruction. So the operation of life science firm in a free market economy is a complex and often controversial dynamic. On the one hand, you have businesses that exist to create a profit. They do this through cost efficiency, implementing a unique strategy, and focusing on growth, which is reflected in their overall stock price. On the other hand, you have life science firms that exist to design, develop, and distribute life-saving products that increase overall human health and well-being. What our team decided to do was take a look into empirical analysis in the R&D heavy life science industry and look at how many buybacks they were doing relative to research and development. So what are stock buybacks? So stock buybacks are when a firm purchases their shares from the open market, decreasing the overall amount of shares outstanding. Now, there's some advantages to this, disadvantages, and overall relation to short-termism, the theme of this event. Some of the advantages include that when a firm is buying back their shares, they are giving investors capital. Investors have a choice and decision whether they want to sell them back to the company or not. There should also be a boost in overall stock price as there's less shares outstanding. And it could signal to investors that the company believes that their stock is overvalued because they're purchasing it from them. Now, some of the disadvantages include that the earnings per share may increase, but overall operational efficiency doesn't really change much at all, only the shares outstanding. And also, this is a one-time payment. It's not a dividend, so it doesn't happen multiple times. Now, how does this connect to short-termism? As far as short-termism goes, when a company spends money on stock buybacks, they're not spending it on research and development, which could lead to long-term growth and long-term returns. Also, if they don't have cash, that means they're going to change their overall debt-to-equity structuring, using more debt, which will make it harder to finance new ventures in the future. Now, why is research and development important in the life science industry? So drug development and R&D aren't just a cost. They're essential for competitiveness and overall success. Between 2000 and 2018, the world's 27 largest pharmaceutical companies increased their revenue from 300 to 725 billion. During this time, they also increased R&D spending from 12 to 17%. Sustained R&D also leads to medical breakthroughs. As we all know, a couple years ago, the COVID-19 pandemic, if firms weren't investing heavily into research and mRNA vaccines, we wouldn't have been able to respond so quickly to this pandemic, and thousands, if not millions of lives probably wouldn't have been saved through this vaccine. Drug development is also long, risky, and expensive. In the past decade, it has taken an average of 12 years to bring a compound from candidate nomination to market, and it also costs about $2.284 billion. Now I'll pass it on to Nick.
So our research was in part inspired by two government investigations. One performed by former SEC Chair Robert J. Jackson Jr. that focused on the short-term equity impacts after buybacks are announced and executed. He also looked at the rate that senior executives sell stock during these periods. What he found was that there was a short-term benefit to the equity value after buybacks were announced and executed that senior executives took advantage of and sold stock at an elevated rate during this period. In addition, we were inspired by a drug pricing investigation by the House of Representatives. What they found was among 14 large pharmaceutical companies in 2016 and 2017 that took part in share buybacks, they spent more on these buyback programs than they did on R&D. And this brought us to our research question. Our hypothesis is that stock buybacks in the life sciences industry are negatively correlated with both research and development and long-term equity returns. We split our research into two main sections: stock buybacks versus R&D spending and equity performance. Our sample includes 100 companies from multiple sub-industries from 2016 to 2020. All of our companies were based in the United States. We focused on pharmaceuticals, biotechnology, life science tools and services, as well as healthcare services and equipment to gather the real breadth of the life sciences industry. We split our companies into two main groups: treated and controlled. treated being firms that partook in stock buybacks during the periods evaluated, and control being those that did not.
Okay, so next I'm going to be walking us through our results. So first we looked at our sample as a whole, and there's a few things we noticed. First of all, the companies that pursued buybacks were a lot larger in revenue than companies that did not. In line with what the House report saw, we found that companies that pursued buybacks were spending a lot more on buybacks than they were on R&D in every year except for 2020. And we also noticed a spike in buybacks in 2018. And during that year, there was a pretty significant corporate income tax cut, which just provided firms with some extra funding to potentially pursue buybacks or investments in research and development. Next, we looked into R&D as a percentage of revenue across the two groups, and we saw that firms conducting buybacks did invest significantly less in R&D. The average gap between the two groups over the 5 years we studied was somewhere around 7 percentage points, and it did shrink in 2020, potentially due to the COVID pandemic and just a shift in investment priorities. And then we did this same analysis, but for our 3 smaller industries. We noticed that among pharmaceutical companies, the gap was the widest between treated and control firms in R&D spending. It was actually double the gap we observed for our sample as a whole. But interestingly, when we looked at biotech and medical device companies, we saw treated firms actually matching or surpassing the control firms in R&D spending. So what this indicated to us is that the relationship between buybacks and R&D might be industry specific, and what we saw from pharma companies was really driving the results for our sample as a whole.
We also looked at quarterly stock returns and saw that there was a minimal advantage for firms that took part in buybacks across our entire sample. The quarter-over-quarter return for the treated group was 2.6% per quarter in comparison to 2.4% for our control group. This is relative to the average market return for the same period of 3.5% per quarter. When segmented by industry, we actually found that the pharmaceutical and medical device groups that we selected conflicted with this trend. We found that there was a spread that benefited the control group of 1.7% for pharmaceutical companies and 1.58% for medical devices.
And then wrapping up with some key takeaways from our results, ultimately our research challenged the narrative from existing literature that buybacks inherently detract from R&D, instead suggesting that industry context might be a key factor there. And then in terms of stock returns, while it's true that buybacks might lead to short-term share price gains, we ultimately weren't able to establish a clear link to long-term equity performance. However, our results could still have some interesting insights when it comes to different policies that have been proposed, which Julia will get into next.
So several legislative proposals have been raised to improve transparency on this issue. The Reward Work Act suggested to ban open market buybacks and instead require a tender offer. So in a tender offer, companies will publicly offer to buy a set number of shares at a fixed price, giving all shareholders an equal opportunity to sell. The Worker Dividend Act, on the other hand, would require companies that engage in large-scale buyback to give proportional employee benefits, such as cash bonus or stock grants. This would address income inequality, but however, companies might respond by cutting benefits elsewhere. Both of these bills were introduced in 2018, but did not pass the initial stage of the Congress. So now we're looking at other potential ideas. We could link innovation more directly towards R&D by setting a mandatory minimum R&D spending. Secondly, as Maddie mentioned before, the 2018 corporate tax cut resulted in a surge in buybacks. So another solution would be to implement a progressive tax penalty for the excessive buybacks. In addition to these external restrictions, we could also looking at some misalignment in internal incentive. So we could link executive compensation to more sustainable goals, such as ROIC over 5 years, or products develop milestones, so that we would expect firms to make smarter and more forward-looking decisions. Now let's pass on to Aaron.
So back to the main point, sorry, value creation or value destruction. So our stock buybacks a form of, do they create value or do they destroy value? So some people believe that buybacks do benefit shareholders, such as Warren Buffett. In terms of short-termism, in many people's eyes, investors do reap short-term gain as they get paid in capital from the company, and then long-term investors see an overall increase in the stock price, which helps them as well when holding on to these shares. But these buybacks can also limit imitations. Stock buybacks could finance R&D and finance or lead to new growth in the future, and instead they're spending it on buying back their shares now. So this leads us to the overall question, should life science companies serve those who need their products or those who finance them? Thank you, guys.
If our panelists would like to join us at the stage. Okay, with us today, we have Dr. Bill Lazonic and Paul Clancy. If you would like to, well, first, thank you so much for being here. But if each of you would like to take a minute to introduce yourselves and maybe your work, that would be great. We can start with Bill.
Okay, yeah, I'm Professor Emeritus of Economics, University of Massachusetts. I did a PhD long time ago at Harvard and taught at Harvard and Columbia for a long time. My main area of research is actually how companies become innovative. And it's my views on stock buybacks, so we're going to talk about today, are related to understanding how, in fact, companies retain their earnings, reinvest in their productive capabilities to grow big. And then basically what happens is someone comes along who has actually very little to do with them growing big. You call them investors, and grabs the money. Okay, so I've been doing a lot of this research on buybacks for, I would say, 30 years. I've learned a lot over that time. I've followed a lot of companies in real time. And it's had some impact. I just mentioned that the Reward Work Act of Tammy Baldwin was based on the research I've done, which would rescind a rule in 1982 to ban buybacks and to allow buybacks, so they'd be banned in effect, and put workers on corporate boards. And also that a study was mentioned of 14 companies and all the buybacks they did relative to R&D. That often your work doesn't get cited. That was our work, not. Okay, thank you.
My name is Paul Clancy. I worked in biotech. I still work in biotech, so for about 25 years. I worked at Biogen for 17 years, the last 10 of which I was the chief financial officer. I confess I did a lot of buybacks. So I'm sure we'll have a fun conversation, Bill. I then went to Alexion Pharmaceuticals for a short period of time. And for the last 4 or 5 years, I've been serving on life science boards. I'm on 2 medium-sized biotech company boards or life science boards and 2 smaller companies. And then I also do some teaching. I teach a finance class at Cornell's MBA school, and I'm an executive fellow at Harvard Business School.
Well, I think you'll be pleased to hear that Alexion and Biogen were both part of our sample for this study. I guess we'll start with a broad question. In your own words, why do companies in the life sciences industry pursue buybacks? And we can start with you, Paul.
Okay, so I think this is in the broader framework, and it's important to like almost understand the broader framework, the way companies think about what's called capital allocation. And you get taught this a little bit at business school, but it's probably under-taught at business school. And what capital allocation in kind of simple terms is the responsibility of a company to figure out what to do with the company's excess cash flow generation. So if you're an emerging company, you don't make money, you don't have to really worry too much about capital allocation. There's actually a mirror image that people talk about is called capital formation, but that's more how do you access funding to kind of to fund your losses in essence. But once the company becomes successful, they have to figure out what to do with that extra cash flow. And the way to think about it is there are 2 broad categories of what to do with that money, and then there's some subcategories. The 2 broad categories are to continue to invest and build the business or to return it to shareholders. Okay, and investing to build the business, the subcategories are things like capital expenditures, M&A, kind of doing mergers and acquisitions, or R&D, research and development. And you guys studied kind of one subcategory vis-a-vis another subcategory. And then the alternative is to return it to shareholders. And there's two basic ways to return money, the excess cash flow that a company makes to shareholders. One is what's called a dividend payout, and then the other is share buybacks, which you kind of studied. So I think this whole thing starts with a responsibility that companies have, that are publicly traded companies, to do what is the most optimizing kind of dynamic, if you will. And the thesis is that at some point, companies run out of net present value positive projects to invest in. So they kind of run out, they become so successful that they actually don't have any, and if you continue to invest, and you guys alluded to this in your paper, if you continue to invest, you'd be investing in what's called negative NPV projects. And investors would, in the alternative is to give it back to investors so that they can reinvest. So I think that's the starting point for your kind of your question.
Okay, well, I'll actually go off some of the things that Paul said, because there's a lot of layers there that if we peel them back, they're problematic. First of all, the notion that there's excess money, and then it came back to that there's not much to invest in. Okay, the purpose of a pharmaceutical company is to invest in a safe and effective drug and at an affordable, and make it a cost that's affordable and make it accessible. And there may be drugs that aren't as profitable as the ones that are being produced that the world needs. And these are the companies that have the capabilities to do it. They're getting NIH funding. They're getting all kinds of resources, including from all the, there's a reason why all these pharmaceutical companies are in this area, because of the universities and all the resources they can tap into. So if you talk about a responsibility, the responsibility is to do that. Now, return value to shareholders. Shareholders do not invest in companies, public shareholders. So take Biogen. I looked it up. I always do my homework. The last time Biogen raised money on the public stock market was in 2000, about $459 billion, and they did something on their IPO about a decade earlier. Now, first of all, the people who bought shares in an IPO in the biotech companies, since almost all biotech companies go public without a product, they're not going to hold the shares until there's a product. They sell the shares. And in fact, a company like Biogen, which has never paid dividends, they have to sell the shares in order to realize the gain. It's the only way they can do it. So it's share sellers who are gaining. And the share sellers are not necessarily the people who created value. In fact, they're not the people who created value. Okay, so who are they? Well, they're the top executives with their stock-based pay. So I kind of looked up your pay. I know it was about $7 million a year at Biogen with realized gains, and about 82% was stock-based pay. So there's an incentive to get the stock price up from the executives. I call them the value extracting insiders. There's the all institutional shareholders who want to get a higher yield on their portfolios with our money. So they're often investing, and more they're investing with hedge fund activists, who I call the value extracting outsiders, who have become the biggest problem. And I think you know about them because you dealt with Carl Icahn for 3 years at Biogen, and you dealt with, I think, with Elliott Advisors, Elliott Management, Paul Singer's group at, these people are total predators. They have nothing to do with the companies. They have no interest other than to get the stock price up. So there's a huge problem. Okay, now, there's also the notion that if they don't do buybacks, what are they going to do with that money? Okay, what are they going to do with that money? Well, at Biogen or any other company, if they didn't do buybacks, they wouldn't be putting it under the CEO's mattress. The money would go out into the economy and various, so if they're really profitable, they can set up a little bank subsidiary and invest in all kinds of things, including various kinds of corporate ventures that they can spin off. So there's lots of other things that they can do that are about benefit of the company, benefit for the scientists working there. For example, if you do corporate spin-offs, the scientists can go and start some of their own companies rather than do buybacks. Okay, I'll stop at that point. I could go on for much longer, but
Okay. moving on to our next question, hopefully keeping personal details at a minimum. We,
Well, no, well, just, it's not personal details. These are on proxy statements. So this is public information. We should be using public information. There's a reason why we have this public information, and so people should be researching it. What executives make is not something that people should ignore, and executives should defend what they make. If not personally, it's not really personal. It's part of the system. This is what we bestow on executives. So I would take exception to the notion it's personal details.
okay. Moving on, we observed a large spike of buybacks in companies that we studied in 2018 due to the tax cuts, as we mentioned. And we also saw kind of this resurgence where buybacks decreased during the pandemic in 2020, during a time of great instability, during a time when the responsibility of pharmaceutical companies or biotech companies seemed to be on finding a focused cure. How do we think that the pandemic impacted buyback decisions? And I'll give it to you, Bill.
Okay, well, the 2018 spike in buybacks was because of the tax cuts. Okay, so that was recognized in the debate over the Trump tax cuts, which they're trying to institute again, where the Republicans basically were saying, "Hey, great, we're going to give these tax cuts to corporations, and they're going to be able to do more buybacks, and that's going to boost the stock market." Democrats, to their, I think, fortunately, in this context, led by Chuck Schumer, they had what they call hashtag GOP tax scam, and it was about 25 Senate Democrats, some of whom you mentioned earlier, Booker and others, Baldwin, Warren, who said, no, this is what they're going to do with those tax cuts, and that's what they did. Okay, so then you come to the pandemic. Now, in the pandemic, people like Joe Biden, who was running for president, and was a big, he actually, based on some work I had done, he had been a vociferous opponent of buybacks, said that no companies during the pandemic should do buybacks. They didn't pay much attention to them. The companies that didn't do buybacks were companies like in travel and hotels, and cruise lines and things that couldn't. And ExxonMobil couldn't because had that predated the pandemic. But all the tech companies, they went at it like crazy because a lot of them were making lots and lots of profits during the pandemic. And unfortunately, when Biden became president, he shut up about buybacks. He just stopped talking about it, or the people around him told him to start talking about it. And during the Biden administration, buybacks were at levels that far surpassed. It was about $800 billion in 2018. It's close to $1 trillion in 2023, a little lower in 2024. So the Biden administration has nothing to brag about in terms of opposing buybacks.
I mean, I think the other dynamic that happens during a pandemic, this is like broader than pharma, looking back now, we're like, hey, we got out of the pandemic, but there was so much ambiguity. And when you return capital to shareholders, it's easier to stop buybacks than it is to stop dividends. Dividends are a bit viewed as almost like a commitment on a quarterly basis by companies to their investors, whereas buybacks has a little bit more discretion. So I think that, for sure, this is different companies have different dynamics. Tech was roaring at that time, but the majority of companies it was very ambiguous what your cash flow generation was going to be in 2020. So you had to kind of like batten down the hatches to some extent.
Okay. So this question is not on the script here, but in the United States, we pay a lot for healthcare. But at the same time, we created 3 vaccines for COVID-19 very quickly. We come out with more pharmaceutical products than any other country in the world, and they're good products. They help people. On the flip side, we pay more for a lower life expectancy than any other country in the world. So I'll start with you, Paul. Do you think the system is working? And if there are any general tweaks in your mind, what would they be?
I don't think the system's perfect. And this is somebody who's in the middle of the system. So the cost therapies inside I mean, to some extent, you can argue like outside the United States, where the cost of a given therapy, it can be a fraction, like 50%, 30% of a therapy than it is in the United States. What the industry will say is, oh gosh, we're subsidizing the rest of the world. I think there has been, up until recently, probably a lot of, ability to price up probably further than it should be in kind of medicines. And that's changing. I mean, that's changing with some, stuff that happened in what's called the Inflation Reduction Act that, addressed a whole different thing that isn't quite inflation, but it was like trying to allow the United States government in Medicare and Medicaid to effectively negotiate for the prices of medicines. Prior to that, I mean, amazingly, that there wasn't that ability. So, I early on in my career, I spent in consumer products, and when I came to kind of pharmaceuticals, biopharmaceuticals, I was like amazed that almost your number one customer couldn't negotiate a price. So now there is benefits that are often get unnoticed. One is that the participants in the industry that make it, and that are profitable biopharmaceutical companies, for every one, there's got to be at least 15 that don't. So you're kind of paying for the cost of failure. It's a very high risk business. The other dimension is that these are businesses that go off patent. You only have that, effectively good pricing for a period of time, and then society benefits from generic drugs. So society benefits from, for perpetuity, from, what is effectively a cost plus model on generic drugs.
Okay, well, first of all, the broader context, everything has a cost, and distributions to shareholders in general. So we talked about it, I'll mention dividends. That's become a huge source of inequality. And even if it was just dividends, there would be a certain amount of inequality involved here, because about 10% of the wealth distribution have about 90% of the shares. Okay, but when you're talking about buybacks, it's share sellers, and I'll reiterate again that this is not returning some of the investors. Let me give you an example. I think Warren Buffett was mentioned in the presentation. Warren Buffett built up Berkshire Hathaway. It has almost 400,000 employees, run by 24 people in Omaha, Nebraska, and about 70 companies that are protected from the stock market through Berkshire Hathaway. And so those companies, they're not high-tech companies in general. They generate money internally, which are kind of dividends to the corporate office, gives the corporate office, Berkshire Hathaway as a whole, a huge cash pie. And so he goes and looks and puts it into stock, which is a totally different type of investment. So Warren Buffett bought between 2016 and 2018 about $39 billion of Apple stock. Okay. Not 1 cent of that $39 billion went to Apple. It went just to other shareholders. In fact, Apple calls the program under which it has done since October of 2012 its capital return program, which it has done $749 billion in buybacks. It's about over $60 billion a year, and about $170 billion in dividends. That comes out to well over about 111% of net income over that period of time. They call it the capital return program. But the only time that Apple ever got money from the public stock market was in its 1980 IPO. And even Steve Jobs, by 1984, had 1 share of Apple for 85 when he got. So who are they returning money to? So this notion that shareholders are investors, a very good paper by Lenore Palladino, UMass Amherst on this. Public shareholders are not investors, just households that are safe, except some of them have a lot of power to extract value. Okay, so Warren Buffett made that investment, let's say, of his money, or Berkshire Hathaway, to Apple. He sold those shares. He sold most of them recently. He's now got a big cash pile at Berkshire Hathaway, about $330 billion, and realized gains of about 100. Last time we looked at about $158 billion. That's where income inequality is coming from. Okay, and For what? Doing what? No money went to Apple. No, he didn't have to put any time or effort into this. He just had to decide when to sell the shares. And he still need Apple to do buybacks, which he did. During that period, Apple did about 64 billion per year average of buybacks. And I should tell you that Apple does pay dividends, but they do a lot more in buybacks, and they can't get off that train because they did 95 billion in the last fiscal year before 94 billion in profits. Because if they do, Kim Cook will lose his job. And that's really a lot of what it's about now in these companies, that if they don't do the buybacks, the hedge funds will come in and they'll take them over. Jeff Bezos at Amazon, they're doing buybacks now because he doesn't have dual class shares. There's a lot of different reasons why they do buybacks, particularly even if they have dual class shares, but that's the problem. Now in pharma, just the last thing I'll say on this is in pharma, the critical thing that everybody knows in pharma is that if you're going to get new drugs, you got to reinvest in the pipeline, or you got to acquire some companies and develop those companies, not just extract value from them, which has often been what big pharma has done. They've had a blockbuster model where they acquire their companies and just extract the value from the patent life left, and they fall off the cliff. Okay. The Pharmaceutical Research and Manufacturing Association always says, and I agree with this, that they need high drug prices. I agree with the first part of what they say. Need high drug prices in order to invest in innovation. So what our work has shown, and what you've cited some of it, is that the companies that are making these arguments don't need high drug prices to invest in innovation because they do 100, 200% of their net income goes to buybacks and dividends. I can give you that number, but and so what do they need that money for? They need it to prop up their stock price. So we pay high drug prices so they can prop up their stock prices.
So we're here taught a question that corporations do have a fiduciary duty to their shareholders, and there may be issues with that, stakeholder v. shareholder theory as is. So I guess my next question is, how can regulators and boards maybe better align internal incentives with long-term firm value and societal impact without overstepping into micromanagement? And I'd like to start with Paul.
As it specifically as it relates to buybacks, or
As it relates to maybe there needs to be return for shareholders. So maybe value extraction as a whole, not destruction, but how to compensate those who finance ventures.
yeah, I mean, I think if not all companies do this, we're not perfect, but I think if companies focus on long term, the debate starts to come together towards more alignment. And like the best companies who really focus on the long term, incredibly care about employees, incredibly care about their customers, incredibly care about their communities, and they want to do what's right as it relates to the environmental issues. I think many companies would love to see the government step up and make clear regulations on environment. Companies are driven by metrics, they're driven by performance, and they would align on that kind of incredibly. So I think, the greatest companies do this quite well.
Yeah, well, I know this conference is called short-termism, but I actually don't use that term. I think it's innovation versus financialization. I have a broader kind of antithesis between progressive value creation, where you actually pay the scientists and who invest in who put their time and effort into the development of in the pharmaceutical industry of drugs, including all the legacy foundational translational research that's done even before a pharmaceutical company gets involved. But the issue is innovation versus financialization. And the ones where we, here's back to the problem of buybacks, where we see the financialization are companies that have been innovative. But as I said, it's not been just public shareholders who have made them innovative. They've just been there, to get a yield. It's been the people who are working for them and in pharmaceutical, the National Institutes of Health, with its $45 to $50 billion a year in research. So I'll give you one study we've worked on. We haven't released any of it, but it relates back to the pandemic. The two key companies in the mRNA vaccines were Moderna and right around here, and BioNTech in Mainz, Germany. Okay. We argue that there are two very different business models there. With Moderna, they get a hold of science to make money. It was like that when we documented, we haven't released a study, but we've documented it right from the very beginning with the hookup with Flagship Pioneering venture capitalists. In fact, Flagship Pioneering does not sold all its shares in Moderna because it has no interest in building Moderna into a bigger company. It has an interest in doing lots of startups because that's where the money is made. We call them productless IPOs or PLIPOs. Okay, so the other model is you have to get money to do science. That's what the founders of BioNTech, husband and wife couple, Shahin Tarichi, they did there. A long story short, BioNTech will become one of the major pharmaceutical companies in the world over time, building on its success with the RNA. And neither of these companies at the beginning of the pandemic had products yet, but they had different types of funding. They had much more solid funding, long-term funding at BioNTech. BioNTech will become a major pharmaceutical company. Moderna may go under. And the fact is that Moderna did not even develop the mRNA vaccine. It was Barney Graham and his group of people at NIH who developed it, and they gave it to Moderna. They didn't do the manufacturing. That was done by a company, Lonza, Swiss company that happens to have a manufacturing plant about 90 minutes away. So you really have to look into these companies and really, are they innovators or are they ones that are just getting hold of science? And in the pharmaceutical industry, it's one of the unique things about it is that companies can go public without a product. There's a lot of reasons why this is the case, but it's an industry in which the product development is most expensive, it's most uncertain, yet for decades now, you've been able to put these companies on the market without a product. Why? It's because of NASDAQ, basically, which was, by the way, a government creation, which inspected the stock market, but nobody who's buying those stocks at the IPO is waiting around for a product to be produced, which may never happen. In fact, we've traced companies where they've gone public. We could look at the stock price when they went public. We look at them, could be 20 years down the road when they have a product that actually makes it the market. The stock market is way, way lower at the time when they actually are a successful company, when they were totally just playing this financialization game. But the last I'll say is if any of you are interested, I've always said this to young people, if you're interested in games, why not at a business school create a game about who can make the most money in the biotech industry without developing a product?
So I think we have time for two more questions tonight or today. First one, we mentioned Switzerland briefly, and they have a slightly different regulation regarding stock buybacks. They require shareholder approval, and they have limitations during like earnings seasons release where they can't produce buybacks to short-term boost the stock price. Alternatively, the United States, again, is the most productive pharmaceutical, I guess, innovator in the world, and we have a number of amazing products to show for it. Do you think a system similar to Switzerland would work in the United States, or is our system productive because of something else?
Okay, well, I think our system is productive because we have the largest market in the world for pharmaceutical drugs. If a company like a Roche and Genentech being part of Roche takes advantage of those high drug prices and actually reinvests and become a world leader in innovation. And the US market is really, really important for them. So they love the US market where they can make all these profits. So there's a huge opportunity to just be an innovative company even as you become bigger. You then have all the NIH funding, which people from around the world come here, and now this is being jeopardized, by the way. People around the world come here to do life sciences research, and the companies can tap into it. So there's a huge opportunity in terms of for a company to be innovative. It's just that a lot of companies, under various types of pressures, that may not have to do with what the people in those companies really want to do. I think in every single company there's a conflict between innovation and financialization. People who really want to just get those drugs out there, and people who say, hey, no, let's just, okay, distribute to shareholders, that's all we can do. That's a battle going on. And I think what we have to do is have regulations to support the innovators and really restrict the ability, the power of the value extractors, the one who are into financialization.
Bill, I never thought it was one or the other, innovation versus, so I always thought or creating value for shareholders. I always thought it was both. And I think that's what great companies do. I don't think, original question, I don't think adding more burden to share repurchases would help that much. I think that there should be, and I think there is, incredible oversight by board of directors on big decisions like this. There should be this disclosure. And if, investors aren't satisfied with kind of the way companies move over a long period of time, they can sell, they can vote against them, et cetera. So I don't think it's additive.
Can I ask you a question? Do you know why companies can do the massive, why, I mean, at Biogen, I think in your period there was something like 16.7 billion. Apple, as I said, is way by far the leader. Why they can do so much buybacks and not be charged with manipulating the market?
I mean, it's governed by 10b5-1 rules. You can't do it when you have
No, but that's
material
not the reason why you
information.
can do it. It's Rule 10b-18, which
Yeah.
is November 1982. The SEC, without any public comment, actually, passed a rule that a company, among other things, can do 25% of an average daily trading volume in buybacks on any single trading day, and you can do that trading day after trading day, and you're given a safe harbor.
I'm sorry to interrupt, but I think we have to get back towards our original topic of farmer
This is the
companies.
topic. This is why buybacks are being done. Do people know about 10b-18?
I don't believe so.
Well, then you should, because if you're asking what you can do about buybacks, that's in Tammy Baldwin's Reward Work Act, is rescind Rule 10b-18. This was just the SEC. It was never vetted by Congress. It never has been vetted by Congress. The SEC making a ruling under Reagan, putting a banker for the first time since Joseph Kennedy in charge of the SEC, the Chicago school capturing the SEC, passing a rule that says that Apple can actually do 5 billion buybacks a day and not be charged manipulation in the market. The SEC never said it wasn't manipulation. They just said, if you do this under this amount, it won't be charged with manipulation. And we don't even know how much they do on any particular day, because the SEC said we don't want to burden companies by having to read those. So people, it's a big part of the question, because it's a very easy thing to do, is to look back. The Trump administration isn't going to do it, and it turned out the Biden administration didn't do it, but Tammy Baldwin tried to do it. Look back and say, why is this allowed? And just say, take it out of the game. Just ban it. That's all that you have to do. And then you would have anybody who holds stock, they would say, oh, they can get their dividends, or they can hold the stock. If they don't want to hold the stock, they can sell it, hopefully for a capital gain on the market. And they're more likely to make a capital gain if the company reinvests. And I might say that companies that retain and reinvest and don't do buybacks, maybe because they can't, and even don't do dividends, when they are successful, they are hugely successful. They have much higher stock prices than companies that try to manipulate their stock prices.
Paul, if you want a chance to respond to that, you can. Okay.
Right.
Last question. We have to keep this brief. I think we're a little short on time. In your opinion, what additional research is needed to better inform professional practices and policy in the industry? And I guess we can start with Paul, if you'd like.
Yeah. Well, one thought as it relates to your project is I'd add R&D and M&A to be thinking about how does that compare? Because when you guys said it, as companies get bigger and pharmaceutical companies look to build their pipeline because they know the products are going to go off patent. They want to keep becoming going concern. And the decision of organic R&D investment or inorganic access from M&A is viewed as either one is fine.
You're saying M&A is a form of value creation in a way.
Absolutely, it can be.
Yeah, that's,
yeah,
we didn't
if-
think about that.
Yeah, yeah. So, and it's probably a good way to think about vis-a-vis, versus kind of return of shareholder.
Well, okay, so I have what I call a theory of innovative enterprise. Take it from me if you don't know about it. It's a powerful tool for actually looking at how companies innovate and how they stop innovating. Okay, and it has to do with what I call strategic control, controlling the company, organizational integration, how they do learning in the company, and how they get committed sources of finance to fund that innovation process, and then how they might turn from innovation to financialization. And the only way you can really do this, really understand this, is by actually looking at companies. So they're not just case studies. There's accumulation. This is where the action is going on. So there's if you're interested, there's a book with a fellow named Owner Tolan, another co-author named Antonio Andrioni, that's out from Cambridge University Press. I think it's free online. On AstraZeneca, GlaxoSmithKline, how over the last decade they moved from financialization into innovation. Partly because in the case of AstraZeneca, they saw that they would have got, and Pfizer tried to take them over, that if they didn't invest in the pipeline. So Pascal Soriot at AstraZeneca, he's getting all kinds of pay. He's one of the highest paid people in the UK, so he's getting the benefit of this. But at least the company is been on an innovative path. Okay, and there's a number of reasons why that happened. Sometimes companies have to stop doing buybacks. That's the case of Pfizer, because the business model for big pharma was for a long time acquire other large cap or mid cap companies that have already blockbuster drugs or drugs that have a lot of patent life left and milk them dry. That's what Pfizer was doing. That was Merck was doing. Pfizer was falling off patent cliff. That they actually, before the pandemic, they stopped doing buybacks because of that. They brought in Bourla to try to invest in the pipeline. The reason they had a hookup, which was very profitable with BioNTech, was because they were looking for those opportunities with small companies. And so that, in fact, first when BioNTech said, "Do you want to partner with us in the mRNA vaccine?" they said no. And then when it was declared a pandemic, they said yes. But the thing is, Pfizer actually, except for 1 month, March of 2022, has actually not done buybacks because they recognize that they can become vulnerable if they start getting on that wagon again. Now, I might say that I was curious why for 1 month after not having done them since August 2019, they did them in March of 2022, $2 billion. Their stock price was low. They got it up. Their CFO was leaving, a guy named Frank D'Amelio. I think it was a goodbye present to him to get the stock up before he exercised all his unvested options or awards.
All right, well, thank you so much to our panelists again. Thank you for coming today.